All right, so we're looking at the interims for Tortilla, October 2023. If you've seen this in the future, you can see if any of my predictions came true. So we've got the CEO, Richard, and CFO, Andy. And then they're going to look at the results and financial review and strategic operations, etc. So good progress on the UK. 5 stores opened today, including first in Northern Ireland. Chilango acquisition is proving successful. They're growing the franchise. Cost pressures and inflation is going down. Successfully launched 2 major tech projects. First kiosk-only site, a bit like McDonald's, and a nationwide rollout of delivery, order aggregation software. Interesting. Tortilla Sunsets, project developed. I think that's maybe a new product, maybe. Currently assessing a number of European opportunities for franchising or strategic acquisitions, and the strengths of board with Keith down as a non-executive direct, and Andy, the CFO, has been promoted to managing director. The finances, revenues increased by 22%, adjusted EBITDA of 1.8, which is a little bit down, which is on track with market expectations due to a year-on-year decrease in governmental support. Balance sheet remains strong, got a small net debt position of 1.6, but they're saying they have cash generative model, which we've seen. Okay, let's have a look. So we've seen, let's look on the right first. So revenue's up, cost of sales is also up, gross revenue profit up quite a bit, actually, that's pretty good. Percentage of revenue same. Admin expenses up like 5 million. You know, I'm always curious about like what that actually means. I've seen it before with a few other brands, and it's just confusing to have like, I don't know what, they never seem to break it down, these admin expenses, but it's like a huge chunk of the revenue. You know, if you think about it, revenue's up 6 mil, just under 6 mil, and admin's up 5 mil. So, you know, it's a huge chunk of it. So profit is down. I guess they're expanding. So overall, it's not good. But they're growing. So this is just a one-off interim. Revenue's growing, revenue's growing, expenses are growing, basically in line. So I want to talk about how they can get out of this rut, because you obviously want to grow a business above its cost base, or it's not a business. But I do like Tortilla. Let's have a look what's going on. Some VAT stuff. They're opening new stores, but they're really focusing on Chilango, and they're growing franchising a little bit as well. So they opened 8, they acquired 8, and there was some stores from additional openings in H1 financial year 22. They also closed a lot of stores as well. This has pretty much remained broadly flat in terms of delivery and store earnings. The like-for-likes, 8.4% up, which is pretty good. They're not doing TV ads or anything, so that's pretty good. But these are the costs. Costs seem to be going down, which is very, very good. Utility costs, they look like they're going down. They've been hedged slightly, I guess, with options or something. So that's good. Just an EBITDA. 500,000 of margin improvements, I guess, from the inflationary pressures in the previous slide. They generate 40% of EBITDA in H1 and 60% in H2 due to seasonality. And they expect an additional 1.3% of adjusted EBITDA margin improvement from management initiatives. So let's see what they could be. I don't know if they talk about them or not. The balance sheet. Okay, let's look at this. Tangible assets, same, that's fine. Right of use assets, roughly the same. Property, plant, and equipment, up, I guess, due to the expansion, so that's good. Inventory is the same. Trade and other receivables up 20%. Cash down quite a bit, I guess, due to the cost of the Chilango, maybe. Refits and things. Lease liabilities up slightly. Lease liabilities up slightly. Loans and borrowing flat. Yeah, okay, it's not strategy and operational review. So now I've got 85 stores. They've opened a few: Derby, Greenwich, and London, South London. Actually, where my grandfather was based. Actually, no, he wasn't in Greenwich. He was in Blackheath, which is nearby. Manchester Piccadilly, the shopping centre. That's opened in June of this year. And opening first in Northern Ireland in Belfast, and over in Bracknell. So they wanted to focus on Chilango, which is why they're not opening as many stores as they could have done or should have done. So they're on target to beat their IPO expectations, you know, with over 100 stores in the next few years. I still think this is really conservative and really slow. I think they should be really expanding the franchise operation. Why can't they have individual franchisees? Why not? People are people. You find good people, and they can open up, franchise stores. A bit like McDonald's has lots of franchisees. I'm not quite sure why they're doing it in this manner. I know they want to do slow and steady, but honestly, I think there could be hundreds of tortillas in the UK and abroad. So I don't understand why they're only building 8 to 12 a year. I know that it's above their like super conservative target of 95 stores over a kind of 5-year period, but yeah, I still don't understand that. Anyway, maybe it's because of this. The competition isn't growing very much in the UK. Chipotle, that only has 16 stores, and they opened their first store like I think it was over a decade ago, it was ages ago. So no one's really growing that quickly in the UK. Looks like this French burrito or fresh burrito in France has got a decent amount of stores, and there's a few in the other countries as well. Maybe these are acquisition targets. That would be not a bad idea. There could be acquisition targets, Zambrero, Elmex, maybe in Spain. I suppose the last thing I want to say about this is like, I think if you have a really strong competitor that's growing fast, it would push them along a bit more. But at the moment, I don't see these as big competition. So maybe they think building 9 or 10 a year is great. I think they should be pushing it more personally. So they built 10 last year, and they've opened 4 this year in the 10 months that we're at. I suppose this was released in October, but it's not quite covering up to October, so they might have built a bit more than that. They're relying on kind of like organic maturation. What I mean by that is like they don't do that much in terms of marketing. So they build a store and then they wait for the sales to go up. And that is what happens. But the thing about having a bigger store count, number one, is your brand is bigger anyway. If somebody's coming from Manchester and they like tortilla and they're coming to Birmingham or London, then they can go to a tortilla there. But if they're going to Northern Ireland or Scotland or Spain or Portugal and there isn't a tortilla, that's a shame. So that's on the store rollout front. But on the marketing front, once you have hundreds of stores, you can start doing like a lot of like YouTube ads or TV ads. You've got the revenue to fund that, and that really does expand both retention and increasing the number of sales that one gets from things like delivery, and also helping those new stores to grow and mature. That's exactly how Domino's Pizza did it in the UK, and now they advertise all the time. They didn't have that many stores in the early 2000s. Now I think there's 1,200 or something. Anywho, these are the stores. They cost 425k. Belfast has produced 24,000 a week, which is over $1 million a year, which is good in revenue. Bracknell is having slightly less, 11,000. So that's about 500 or 600k a year. Will cost 400 to build. They bought 8 sites. 5 have been rebranded as Tortilla. Good return on capital, like potentially 30%. If all stores could get that, if we think about a £400,000 investment, 30% of that would be about 120 a year. It's pretty good. I'm sure it might be a bit different than that. But anyway, franchising, this is the most interesting, exciting, expandable, low cost, no-brainer for the business. They should really be looking to expand this much quicker. They've got some franchise partners, but nobody's looking to grow particularly quickly. Travel hubs, they could have hundreds of these in the UK. If we think about rail and road and air, there's a lot there. University campuses, there could be tens, if not hundreds of those. And the Middle East, they want tortilla as well. So I don't know what's stopping tortilla from growing a little bit faster. Maybe they need 1 or 2 people just heading up the franchise part of the business to grow it. They've got this digital style concept, which it's basically modeled what it looks to me on McDonald's, because McDonald's put in kiosks years ago. And this looks very good. I think this is a good thing to do. It means that when there's a big line, people don't leave because they go to the tablets and they order there. And that makes complete sense. And if they have a window where people can pick things up, then that helps as well, because people aren't queuing. I think is a bit annoying. But if you've ordered and you just at the back of the store on your phone or whatever, you can chill out a little bit until your number kind of pops up. And I think a digital kiosk is a great idea. So they're doing some marketing. They've got some loyalty, and they're doing some new menus, chicken pibil, which is interesting, and these tortilla sunsets. So that's good. Interesting. And there's a happy hour. They're not doing any TV, or I don't think they're doing much paid marketing either, but I think that would be good in the future if they could grow the store count by franchising, which lowers the capital expenditure, and then they can put a bit of money into growing the pie in terms of marketing. This just goes on to the unit economics, which we're not going to look at. Current trading. So they're talking about July and August, which is past, but they're just saying it's going well. Da-di-da-di-da. Sunsets and kiosks on track to yield positive upside. UK new stores, 8 to 12. European growth, franchising, UK profitability, increasing margins. Digital kiosks and product and marketing. Wow, a bit big on there. Yeah, I think I agree with all this. They just need to be doing like more of it. And in my mind, like faster. Like Chipotle, I don't know how many stores they build like globally. It's probably like 200 a year or something, or 100 a year. It's probably loads. If you know, put it in the comments. Like, so I just think they could be thinking bigger. I really think the European and the franchising opportunity is enormous. They don't need to rely on their own capital to do this. They should think about opening up to individuals. I don't see much of a risk there if they get their systems down. So I'm going to quickly look at the share price. I don't normally look at share prices, to be honest. I think it's gone down. So if we look at it over 1 month, it's down 16%. Over 6 months, it's down 50%. 1 year, 35%. So it's gone up and down a little bit in the last year. About over 5 years, and the max flowed at about 200p. It's now at 60. It's like so unbelievably low. You know, at 23 million. The value is only 23 million. Let's quickly go back to the deck. The right of use assets, I think that sounds like, you know, the ability to operate from a store. So I wouldn't call that an asset. But plant and equipment that's 14 million. And they've got inventory and things like that. It's probably another 5, let's say. It's 19. Lease liabilities, you know, if they close the businesses, then they wouldn't have those. So 19. So it's basically, you've probably got about, I think you've got about 2 or 3 million, even removing these right of use assets and then the lease liabilities, because if you're not using them, they basically cancel each other out. So it is about 2 or 3 million in terms of the assets. And you know, if they have 100 stores, I mean, let's have a look at how much they're making now. Okay. Yeah, the real problem is that they're not actually making too much from the stores at the moment. So let's just take a look and see at the annuals, because I know they make more, you know, in the second half of the year. Let's have a look at what happened in 2022. I mean, they got adjusted EBITDA of 4 million, but the profit from operations is low. You know, I know they're getting over things from COVID and everything else. I really think this is a good business long term, but just right now, their admin costs are like crushing them. It's just kind of mad, really. If we think about this, the revenue is 57, admin cost is 43. So operationally, I think they've got something which isn't quite working. It's not a very profitable business considering how many stores they've got. To me, that's what I can see. And also, I think they need to be looking at franchising more, because you can probably have one franchise manager managing tens of franchisees. You know, then they can pay for most of the things. Maybe can share the refit costs or whatever. But I think franchising, I believe, is the way to go. Short term, I think the shares could continue to go down, but I think it's an interesting buying opportunity because potentially, because if each store made 100k, so I think they want to get 10% profit margin, something like that. I think I remember reading that somewhere, but let's just say it's 10% of revenue, and each store makes about 1 million. They want 100 stores, then that's 10 million. If they make 10 million, they're only valued at 23 million. Now, if we're thinking 3 years from now, that would mean if they're on a 20x valuation, 20 PE, 20 PE times 10 million is 200 million, and they're valued at 23 million right now. So the question is, if they can control costs, if they can grow the estate, if they can get 100k per store, then this could easily 10x, in my opinion. But there's a few ifs. There are a few ifs here. Is it better to acquire brands and then refit them, like the Chilango acquisition? Or is it better to use these owner-operated rollouts? Or, like I'm suggesting, is franchising the way to go? They've closed delivery stores, so maybe delivery didn't work for them, which is unusual, to be honest, because I thought it worked really well. I did order from Tortilla, and it was like super soggy, and it took ages. So I don't think they can actually cope with it. I think the delivery model they couldn't crack, because probably, I'm not sure why. So yeah, it's been a little bit disappointing in terms of the share price. I mean, I invested kind of a little bit on the way down, to be honest. Probably between about 150 and 100 is when I invested. And, you know, I've got I guess I've got a question to ask. Do I believe in the brand, and do I believe they can get it to 100 stores and profitable? And I think I do. I think, yeah, I think they can do it.
Good afternoon, ladies and gentlemen, and welcome to the Tortilla Mexican Grill PLC half-year results investor presentation.
I'm going to go to the Q&A bit.
We've
looked at quite a lot of this.
Come from you at the end. Thank you.
Okay. Right, well, Paul S., thank you very much for that. And we do own Chilango, so that's good. I'm sorry that you consider that to be better, but actually maybe I'm not, because we love Chilango as well. We think that it's fantastic. So, fair comment. Are we considering raising more equity to finance growth acquisitions? At this stage, probably can't really answer that. I think it's probably unlikely the stage we're at with the business in its current state with regards to the share price.
I think our preferences would be, if we were to do anything, though, is promote money. Obviously, we've still got 7 million undrawn on our debt facility. So if we need to access that, that's clearly the preferable route than raising money in the current climate.
Exactly. Do you want to take the ROCE?
So there's a question here around, can you share some details about how you calculate the ROCE? So we calculate, simply, we just take the capital costs that we incurred. So recollect, we were saying we were spending around 400 to 425,000 on a new site. We take the EBITDA at maturity, whatever that EBITDA is a percentage of the growth of the CapEx needs to be more than 30%. So yeah, that's a mature EBITDA, which for businesses in London.
So wait a minute, if it was 30% return on capital and they had 100 stores and they're all making $1 million, let's say on average, of revenue, that's like 30 million in profit for 2026. Let's say 2027, it takes a year to get to maturity. 20%, 20 PE of 30 million would be a 600 million valuation. They're only valued at 23 million right now. So that's like a nearly 30x return if one invests today and if they can achieve a 30% return on capital. So that is something to be positive about. I know there's been a bit of negativity in this interim, but the long term is interesting. Let's continue.
London happens within 12 months. Outside of London, it's more like 24 months, depending on the location. Okay. What's the point of clarification? Is the intention going forward to fund expansion internally? Yes.
Yeah.
Good question.
Yeah. And then, do you have something you can share regarding the return on investment on the kiosks? We needed to generate an extra £800 a week from the kiosks in order to return the capital expenditure. We're generating 1,200 quid a week extra, and we're only 5 weeks in. So
nice.
that was the kind of main hurdle we were working on towards that. You keep referring to yourself as
oh, yes, very good, yeah.
Yeah, I mean, obviously, a rollout story like ours, you have got the depreciation on your stores, and that is always something to consider. But we believe that the right strategy for the business is to continue growing and continue to pursue growth. And, you know, the profitability challenges we've had over the 12 months, obviously, a lot of them are being alleviated. So we can see that coming back nicely in sort of future periods.
I wanted to ask about the new openings in full year 23 in March. The announcement target was 10 to 12, and it seems you'll end the year at 8 instead, which speaks to the challenge of opening new sites going to the earlier target. Well, I think I sort of highlighted that, but yes, that's correct. That was the target. I think we also stated that we wanted to be very sure that we wanted to check the sort of sentiments of the market at that particular time. We didn't want to draw down too much debt to do that. We wanted to make sure that we were in a place to open that many sites whilst we were still in the process of dealing with Chilango. As it turns out, we'll end up opening 8, which is a little less than we'd hoped, but it is still keeping us on track with our 45 sites over 5 years. So we don't consider that to be a massive shortfall. And I think, as I stated earlier, we did have a couple of sites that we could have pushed into this year, but we felt like we were happy to move them out to next year. So there's nothing suspicious about it. It was just something we felt was probably the right thing to do last year.
There's a question from Connor around our intention to franchise in Europe and how we're set up for that. So you're right, we obviously do not have any stores at present within continental Europe, but obviously we've proven the concept outside of Europe with our presence in the Middle East. The franchise model, there's some very exciting synergies to be had from franchising in Europe, not least because most of our supply chain, the food comes from Europe already, so through Europe into the UK. So there would be some interesting synergies to access in terms of potentially having a CPU presence in Europe and supplying our food to franchise partners in different European countries that way. Although they're relatively small businesses, there has been some moderately successful growth stories in different European countries selling similar burritos and tacos like we do. And having tasted the competition's products, we think what we do is better. And so actually there's some structural advantages as well with European countries where the rents can be lower, and actually the VAT rate on hot food is as low as sort of sub 10%. So with a 20% rate in the UK, we do have a bit of a disadvantage here. So we're quite excited by the opportunity to make it work in different countries.
Yeah, so that's really interesting, because if they franchise in Europe and VAT is half, that presumably adds 10% on to, revenue and profits, right? The costs aren't going to go up. And if rent is lower as well, then maybe they're looking at 40% or 50% return on capital. And if they franchise, it could be even greater. It could be 55% or 60%. So I think that's really interesting. And that's really, they should talk about that a bit more in their presentation rather than just do it in a QA. Like, it's really very commercial and imperative to their growth case, I'd say.
At what store level do you need to open another central operated kitchen? It's a good question. The changes that we made with our chicken pibble process has bought us more time in terms of our current unit. As we just talked about with Europe, any central operated kitchen, we wouldn't supply that from the UK. We would open something overseas and do it that way. So the key there is getting enough critical mass of presence to justify the capital expenditure required to build that kitchen.
That could lead it to buy a competitor abroad. Then you get the stores already.
We're not selling tacos on delivery. Yes, I would have to say the reason we don't is a quality issue. We were warming some flour tortillas, and suddenly, when they're not wrapped up like burritos and wrapped in silver foil, they can get very sticky. They're not the easiest things in the world to eat, and certainly after a journey on a bike, and not to look particularly wonderful on arrival. That's not to say that we're not trying to find ways of doing that. We know they're very popular. We're always looking at better ways of packaging our food from a delivery and a takeaway perspective, and that is one of the areas we're looking at for those products.
They need to crack that. If they crack it, there's a big growth opportunity.
Okay. Right, which one next? In terms of a rewards membership, are there any plans to build an app? Obviously, there are bigger businesses like Starbucks and Greggs. I think the view on apps is quite mixed. I think there is a view that people are a bit fed up with apps and there's too many of them. App fatigue. It's something we're looking at. I mean, obviously, as I said in the presentation, we do have a new head of IT, and we are reviewing.
Waste of money in app. What's the point?
Lots of different sort of tech options for us. Definitely, there's more opportunity with kiosks, and obviously the thing that we did in terms of putting in some delivery application software. Those things that were the obvious low-lying fruit for us. But of course, things like apps and other ways that we can get consumers not just via apps, but to click and collect. Can we try and push more of the orders to come in? People just come in and pick them up rather than queuing. There's lots of opportunity on that type of thing as people get used to the idea of ordering in advance. So just looking, there's some duplication in terms of questions here. When you calculate the return on capital, do you calculate the same? What would be your profitability? Obviously, there's a view here that adjusted EBITDA isn't a real number. I mean, I guess the reality is adjusted EBITDA for us is the most equivalent way of looking at the underlying results, you know, removing the noise. Clearly, obviously, you would always look at your depreciation and amortization, but as long as you're keeping your depreciation policy unchanged and you're keeping your capital costs down, that's the best way to sort of performance assess things that happen below the line. We include all our capital costs in our ROCE calculations. So we believe we're looking at a proper sort of returns exercise when we're reviewing our new site expenditure. And then there's a question around how we're funding your CapEx. We will fund our CapEx from our own cash. As we mentioned there, we've only got a very minor net debt position, although we do have further debt facility for us to draw on when our profitability comes back, as we explain the reasons why it will. We will return to a position where we can fund from our own cash.
Okay. We can't really talk about
Connor's noted 83 burritos from Tortilla this week. The Pibble is 10 out of 10. That's good to hear.
Thanks, Connor. I'll give you the £10 next time I see you. That's great.
Would Tortilla entertain acquisition talks? I mean, we obviously can't really talk about that. I mean, clearly, with our share price as depressed as it is, we're significantly undervalued in our opinion in terms of a multiple of EBITDA. How confident is the management team in the future of the business? Is the management adding shares to their personal portfolio? Would be great shareholder alignment. There's a very good chunk of shares still held by the management team, and obviously we have an exec team with an LTIP, and everyone is incentivized to drive the business. And you know, we've got very young, excited, driven people in the organisation, and we feel very confident about their alignment with shareholders.
I think that's it.
Richard, Andy, absolutely. And thank you very much indeed for addressing all of those questions that came in for investors this afternoon.
Okay, well, they've answered some of my questions. It's short-term blips and the share price will continue. They think that it's undervalued. I think it's undervalued. And I think long-term, if they can crack franchising, especially in Europe, if they can buy other companies, if they can grow their store portfolio, hopefully bigger than 10 a year, then they can be a big company. You know, if they can crack their ROCE or return on capital employed above 30%, maybe 40, 50%, once they hit 100 stores, you know, we're off to the races, and it could go up. The valuation could really go up considerably. I think well north of 100 million, if not 200, 300, 400, you know, 10 years from now. So it's a long-term play, which I know it doesn't float everyone's boats. But these things are, you know, you get the biggest results from the most long-term view, you know, and you find that with everything, even including things outside of investing. Hope you've enjoyed this video. If you have, make sure to like and subscribe. Check out my other videos around shares, angel investing, and other types of investment. And I hope to see you guys in the next upcoming video. Remember that knowledge is power, especially the right kind of knowledge, and progress is everything. See you guys. Take care.